It certainly seems that when it rains, it pours for the Chinese ADRs over the past month or so, and some of it has been justified. I think the fact that these shares do trade very much as an inverse correlation of U.S. bond yields, it was not to be, you know, unexpected that these companies would fall as U.S. Treasury yields rose to 1.6, 1.7 over the course of the last few weeks. However, some of this now is beginning to look quite overdone. When we've analysed the earnings and also target price changes for the Chinese ADRs over the past month and indeed past 3 months, actually in aggregate numbers have actually improved. So there's an underlying fundamental story for the ADRs. It's just been very much a valuation problem, irrespective of some of the regulation overhang that's also appeared in the last week or so. So the bottom line really is that I think the trading range for the Treasury yield will be somewhere between 1.6 to 1.8 now, and a lot of these ADRs will start to look quite interesting, I think, over the next quarter, because there's not any material change to the macro story in China at the moment.
Sure, but given that we are, counting down to Bilibili's listing later in about 10 minutes from now, the Hang Seng Index has dropped 22% from its mid-February highs. Is that a buying opportunity then, you think?
Well, in terms of the China markets that we like, the HSI is by far and away the best area to be investing in. Not only do you have a steep yield curve, you have very loose monetary conditions, and the starting point for valuations in the H and also the private companies is far better than in a lot of the other developed markets that we cover. So in many ways, the HSI has a lot in terms of easy policy versus what's happened in China in the course of the last quarter. And again, doesn't have the issues of the rising Treasury yields affecting the majority of its stocks. So HSI is certainly probably the best of the equity markets for Chinese investors at the moment.